All right, let's talk about something absolutely crucial if you're thinking about doing business in Japan.
So you're looking at the Japanese market, great. But there's one thing you absolutely have to get your head around, their consumption tax, known as Shouhi Zei. We're going to break it all down for you in the next few minutes. Ready? Let's get into it.
Okay, first things first. What is this tax? And maybe more importantly, how is it different from the tax systems you're probably used to?
So, at its heart, it's an indirect tax on pretty much everything you buy. The basic idea is that while the end consumer is the one who really pays for it, it's the businesses, like yours, that have the job of collecting it for the government.
Now, this is where it gets really different from, say, a typical U.S. sales tax. See, a sales tax usually only gets applied at the very end, when the customer buys the product. But not in Japan. Their consumption tax is a value-added tax, or VAT. That means it gets added at every single step of the process, from the person who makes the parts, to the one who assembles it, to the wholesaler, and finally to the store. Every step adds a little tax.
So, the big question is, how much are we talking about? Well, it's actually pretty straightforward. The whole system really just boils down to two main numbers.
For most things, we're talking the vast majority of goods and services. The standard rate is a simple 10%. Easy enough, right?
But there's also a lower rate of 8%. This is for certain everyday essentials, to make things a little easier on people's wallets.
And this is a perfect example of how that works in practice. It can be kind of quirky. Take coffee, for example. If you grab it to go, that's just a food product, so you pay the lower 8% rate. But if you decide to sit down and drink it inside the cafe, well, now that's considered a dining-in service, and boom, the tax jumps to the standard 10%. Same coffee, different tax.
Okay, so we've got these two rates. How does this actually work for a business? When it's time to actually calculate and pay the tax. Let's break down the mechanics.
The whole point of this system is to make sure tax doesn't just stack up on top of tax. It's actually pretty clever. Your business only pays tax on the value that you add to the product. So here's how it works. You collect, say, 10% tax on everything you sell. But then, you get to subtract all the tax you paid on your own business purchases and supplies. The final amount you send to the government is just the difference. That's it.
All right, now we're getting to a really important question, one that every business asks. Do I actually have to deal with this? The answer is, maybe not. It all depends. And what it depends on is this magic number, 10 million yen. That's the threshold. If your annual taxable sales are over that, you're in. If not, you might be exempt. But here's a key detail. They don't look at your sales from this year. No, they look at something called the base period, which is actually your fiscal year from 2 years ago. This is actually great because it gives you time to prepare and know what's coming.
So, it sounds pretty straightforward, right? Over 10 million yen in sales 2 years ago, you're a taxable business. Under that, you're tax exempt. Simple. But, and this is a huge but, a recent change has made this distinction incredibly important, especially if your customers are other businesses.
And that leads us right into the single biggest shakeup to the Japanese tax system in years. It's called the qualified invoice system. Listen up, because if you're in the B2B space, selling to other companies, this is for you. This new system doesn't just affect your books, it directly impacts your customers' finances too. It's a real game changer for how tax deductions work.
Okay, remember how we said you can deduct the tax you paid on your business purchases? Well, here's the new rule. To claim that deduction, you have to get a special document from your supplier. It's called a qualified invoice. And here's the kicker. Only registered taxable businesses can issue one.
And this is the bottom line. If your supplier is a tax-exempt business, they can't give you that qualified invoice. And if you don't have that invoice, you can't claim your tax deduction. Plain and simple. That means the tax you paid on that purchase just became a real cost to your business. Your expenses literally just went up. Okay, so let's pull all of this together. As you're planning your move into Japan, what are the absolute key takeaways you need to have front and center? Here's your checklist. 1. Know the two rates, 10% and 8%. 2. Remember that 10 million yen sales threshold. That determines if you're on the hook for this tax in the first place. 3, and this is the big one for B2B, that new invoice system is everything. It dictates whether you can get your tax deductions. So what do? 2 things, right now. First, check the tax registration status of all your potential suppliers. And second, decide if you need to register as a qualified invoice issuer so your customers can get their deductions from you.
And that leaves us with one final crucial thought. Because of this new system, the most important conversations you'll have about tax in Japan might not be with your accountant. They'll be with your business partners and suppliers. Their tax status now has a direct impact on your bottom line. It's something you just can't afford to ignore.